Understanding the basics of capital management in bank treasury. Capital management is a crucial aspect of banking operations, especially for a bank's treasury department. In this video, we will delve into the basics of capital management and its importance in the treasury function. What is capital management? Capital management refers to the process of effectively and efficiently managing a bank's capital resources. It involves determining the optimal capital structure, maintaining adequate capital buffers, and ensuring regulatory compliance. Objectives of capital management. The main objectives of capital management in bank treasury are twofold: to maximize profitability and to maintain solvency. By optimizing the capital structure, a bank can strike a balance between risk and reward, ensuring sufficient capital to absorb losses and meet regulatory requirements. Key components of capital management. 1. Capital planning. This involves estimating the amount of capital required to support the bank's operations and business growth. It includes assessing the risk profile, stress testing, and forecasting future capital needs. 2. Capital allocation. Capital allocation involves deciding how the available capital should be deployed across different business units and activities. This ensures that resources are allocated based on risk-return considerations and strategic objectives. 3. Capital optimization. Capital optimization aims to improve the efficiency of capital utilization by identifying and eliminating excess or inefficient capital usage. This may involve restructuring the balance sheet, improving asset quality, and enhancing risk management practices. 4. Capital monitoring and reporting. Continuous monitoring of capital adequacy is essential. Regular reporting to internal stakeholders, such as senior management and the board of directors, as well as external regulators, ensures transparency and compliance with regulatory requirements. Importance of capital management in bank treasury. Risk management. Capital management helps banks mitigate risks by ensuring they have sufficient capital to absorb unexpected losses, thereby enhancing the overall stability of the bank. Regulatory compliance. Adequate capital levels are mandated by regulators to safeguard the interests of depositors and maintain financial stability. Investor confidence. Sound capital management practices foster investor confidence, as they indicate financial stability and risk management capabilities, attracting both equity and debt investors. Cost of capital. Efficiently managing capital can lead to a reduction in the cost of capital by optimizing risk-weighted assets and improving profitability indicators. Conclusion. Capital management is a critical function within a bank's treasury department. By understanding the basics of capital management and its importance, banks can improve risk management, regulatory compliance, strategic decision-making, investor confidence, and ultimately enhance their financial performance. Optimizing capital allocation in bank treasury for beginners. In this video, we will discuss some key strategies that can help you make the most of your bank's capital allocation process. What is capital allocation? Capital allocation is the process through which banks assign their financial resources to different business lines and activities. It involves effectively distributing capital to optimize profitability and manage risks. When done correctly, it can enhance a bank's performance and stability. Key strategies for optimizing capital allocation. 1. Risk-based capital allocation. One of the fundamental principles of capital allocation is considering the risk profile of different business lines and activities. Allocate more capital to activities with higher risk exposures and lower capital to those with lower risk profiles. This ensures that the bank's capital is proportionally allocated based on the potential risks and rewards. 2. Performance-based capital allocation. In addition to considering risks, it is important to allocate capital based on the performance of different business lines. Identify the revenue generation and profitability potential of each activity and allocate capital accordingly. This helps prioritize investments in areas that generate higher returns. 3. Stress testing and scenario analysis. To ensure the resilience of capital allocation decisions, it is crucial to conduct stress testing and scenario analysis. By subjecting various business lines and activities to hypothetical adverse scenarios, banks can assess the impact on capital and make informed decisions on allocation adjustments. This helps in optimizing capital distribution under different market conditions. 4. Dynamic adjustments. Capital allocation is not a one-time process. It requires continuous monitoring and dynamic adjustments to reflect changes in the business environment. Regularly review and reassess the allocation based on changes in risk exposures, performance, regulatory requirements, and market conditions. This ensures that capital remains optimally allocated over time. 5. Technology and analytics. Leverage technology and analytics tools to support the capital allocation process. Advanced computational models, data analytics, and risk management software can help enhance the accuracy and efficiency of capital allocation decisions. This enables banks to make data-driven decisions and improve overall capital allocation strategies. Final thoughts. Optimizing capital allocation in bank treasury can significantly impact a bank's financial performance and long-term stability. By adopting risk-based and performance-based approaches, conducting stress testing, making dynamic adjustments, and leveraging technology and analytics, banks can achieve better capital allocation outcomes. Remember, capital is a precious resource, and effective allocation is essential for the successful operation of any bank. Thanks for watching. We hope you found these strategies helpful in your journey of optimizing capital allocation in bank treasury. Managing risks in bank treasury. An introduction to risk assessment. Bank treasury departments play a critical role in managing a bank's assets and liabilities. They are responsible for ensuring the stability and profitability of the bank by efficiently managing various risks. In this video, we will provide an introduction to risk assessment within bank treasury management and discuss some key considerations. What is risk assessment? Risk assessment is the process of identifying, analyzing, and evaluating potential risks that could affect the bank's treasury operations. It involves understanding the nature and severity of risks and developing strategies to mitigate, transfer, or accept them. Identifying risks. The first step in risk assessment is identifying potential risks. These risks can be broadly classified into credit risk, liquidity risk, market risk, operational risk, and legal and regulatory risk. Credit risk refers to the possibility of borrowers defaulting on their obligations. Liquidity risk relates to the ability to meet the bank's financial obligations as they come due. Market risk refers to the potential loss arising from adverse changes in market variables such as interest rates, exchange rates, or stock prices. Operational risk captures the risk of loss due to inadequate or failed internal processes, people, or systems. Legal and regulatory risk arises from potential non-compliance with laws and regulations. Analyzing and evaluating risks. Once risks are identified, the next step is to analyze and evaluate them. This involves assessing the likelihood of a risk event occurring and the potential impact on the bank's treasury operations. Risks can be quantified, qualitatively assessed, or both. Various risk management tools like stress testing, scenario analysis, and value at risk (VAR) models can help in this process. Risk evaluation involves ranking risks based on their significance and prioritizing them for further action. This helps in allocating resources effectively and focusing on the most critical risks that require immediate attention. Mitigating risks. The ultimate goal of risk assessment is to develop strategies to mitigate identified risks. There are different approaches to risk mitigation, including risk avoidance, risk reduction, risk transfer, and risk acceptance. Risk avoidance involves eliminating the activities or practices that give rise to certain risks. For example, a bank may choose to avoid lending to high-risk borrowers altogether. Risk reduction involves implementing measures to minimize the impact of risks. This can include diversifying investments or creating contingency plans. Risk transfer involves transferring the risk to a third party, such as through insurance or hedging arrangements. Finally, risk acceptance involves consciously deciding to accept certain risks, typically when the potential cost of mitigation outweighs the benefit. Ongoing monitoring and review. Risk assessment is not a one-time process. It requires ongoing monitoring and review to ensure the effectiveness of risk management strategies. Banks should regularly update their risk assessment frameworks to incorporate emerging risks and changes in market conditions. By implementing effective risk assessment techniques, banks can better manage their treasury operations and safeguard against potential risks. Key concepts in capital management for beginners in bank treasury. Capital management is a fundamental aspect of bank treasury operations. It involves the strategic allocation and optimization of a bank's capital to ensure it meets regulatory requirements, supports business growth, and safeguards the financial stability of the institution. In this video, we will explore some key concepts in capital management for beginners in bank treasury. 1. Capital Adequacy Ratio, CAR. The Capital Adequacy Ratio, CAR, is a vital metric that measures a bank's capital strength and its ability to absorb potential losses. It is calculated by dividing a bank's capital by its risk-weighted assets. CAR requirements vary across jurisdictions, but a higher ratio indicates a stronger capital position and a lower risk of insolvency. 2. Capital planning. Capital planning involves setting strategic objectives for capital management, including determining an optimal capital structure, assessing future capital requirements, and identifying potential capital sources. This process ensures that the bank has sufficient capital to support its operations and growth initiatives. 3. Stress testing. Stress testing is a key tool used by banks to assess their resilience to adverse economic conditions. By subjecting their balance sheet to hypothetical scenarios, banks can evaluate the adequacy of their capital buffers and identify potential vulnerabilities. Stress testing enables banks to proactively manage their capital by taking appropriate risk mitigating measures. 4. Liquidity risk management. Liquidity risk management is closely linked to capital management. It involves assessing a bank's ability to meet its short-term obligations without incurring excessive costs or disruptions to its operations. To manage liquidity risk effectively, banks must maintain an appropriate level of liquid assets and establish contingency funding plans. 5. Capital allocation. Capital allocation is the process of assigning capital to different business units and activities within the bank. It requires careful consideration of risk-return trade-offs and alignment with the bank's overall strategic objectives. Effective capital allocation ensures that resources are directed to areas that generate the highest value and contribute to sustainable long-term growth. 6. Return on equity, ROE. Return on equity, ROE, measures the profitability of a bank's capital. It is calculated by dividing net income by average shareholders' equity. ROE provides insight into the efficiency and effectiveness of capital deployment, helping stakeholders evaluate a bank's financial performance. 7. Regulatory compliance. Capital management is heavily regulated to maintain the stability and integrity of the banking system. Banks need to adhere to various regulatory frameworks and guidelines, such as Basel III, that prescribe minimum capital requirements, risk management practices, and disclosure standards. Compliance is essential to avoid penalties, reputational damage, and regulatory intervention. These key concepts form the foundation of capital management in bank treasury operations. By understanding and implementing these principles, banks can optimize their capital structure, enhance risk management practices, and drive sustainable growth. Measuring and evaluating risks in capital management for bank treasury. Effective capital management is crucial for banks to maintain financial stability and ensure regulatory compliance. In this video, we will discuss the importance of measuring and evaluating risks in capital management for bank treasury. Importance of capital management. Banks need to have a robust capital management framework to assess and mitigate risks associated with their operations. Without proper risk evaluation, banks may face financial distress, regulatory penalties, and damage to their reputation. Capital management helps banks maintain financial resilience and stability, enabling them to absorb losses and continue providing essential banking services. Key risks in capital management. There are several key risks that banks need to measure and evaluate in their capital management strategies. Credit risk, the risk of default by borrowers or counterparties. It is crucial to assess the creditworthiness of individuals and businesses before extending credit. Market risk, The risk of losses due to adverse changes in market conditions, such as interest rates, exchange rates, or commodity prices. Liquidity risk, the risk of not having enough liquid assets to meet short-term financial obligations. Banks should maintain sufficient liquidity buffers to handle unexpected cash flow demands. Operational risk, the risk of losses due to inadequate or failed internal processes, people, or systems. Banks need to implement robust internal controls to mitigate operational risks. Measuring and evaluating risks. To effectively manage risks, banks employ various quantitative and qualitative techniques. Stress testing. Banks simulate extreme scenarios to gauge the impact on their capital position. This helps identify vulnerabilities and establish appropriate risk mitigation strategies. Value at risk. VaR banks calculate VaR to estimate the potential losses that could occur due to market movements. VaR provides a consolidated measure of market risk exposure. Credit rating models. Banks use credit rating models to assess the creditworthiness of borrowers. These models consider factors such as financial performance, industry outlook, and collateral quality. Risk appetite framework. Banks define their risk appetite, which sets limits on the level of risk they are willing to accept. Role of technology. Technology plays a crucial role in measuring and evaluating risks in capital management. Banks utilize sophisticated risk management systems that integrate data from various sources and apply advanced analytics. These systems facilitate real-time risk monitoring, scenario analysis, and reporting, enabling banks to make informed decisions. Moreover, automated risk models and algorithms are employed to streamline risk measurement processes and enhance accuracy. Machine learning algorithms can also help banks identify patterns and predict potential risks, assisting in proactive risk management. Conclusion. In conclusion, effective capital management is paramount for banks to navigate risks and maintain financial stability. Measuring and evaluating risks through techniques like stress testing, VaR, credit rating models, and risk appetite frameworks are essential. Embracing technology and leveraging risk management systems further enhances a bank's ability to identify, monitor, and mitigate risks effectively. Strategies for capital planning in bank treasury, a beginner's guide. Capital planning is a crucial aspect of bank treasury management. It involves effectively managing and allocating financial resources to ensure that a bank has sufficient capital to absorb potential losses and support its operations. In this beginner's guide, we will explore some key strategies for capital planning that every bank treasury should consider. 1. Assessing capital requirements. The first step in capital planning is to assess the bank's capital requirements. This involves evaluating various factors, such as the bank's risk profile, business strategy, regulatory requirements, and economic conditions. By conducting a comprehensive analysis, the bank can determine the amount of capital it needs to maintain to support its activities. 2. Stress testing and scenario analysis. Stress testing and scenario analysis are essential tools in capital planning. By subjecting the bank's balance sheet and income statement to various stress scenarios, the bank can assess its resilience and identify potential capital shortfalls. This information can help the bank develop contingency plans and adjust its capital allocation accordingly. 3. Diversifying capital sources. Bank treasuries should explore multiple sources of capital to diversify their funding and reduce reliance on any single source. This can include raising funds through equity issuances, debt instruments, or hybrid capital securities. Diversification improves the bank's capital structure and enhances its ability to absorb losses during adverse market conditions. 4. Optimizing capital allocation. Efficient capital allocation is crucial for maximizing returns and enhancing risk-adjusted profitability. Bank treasuries should evaluate different business lines and projects based on their risk-return profiles. By allocating capital to activities with the highest potential return and appropriate risk levels, banks can enhance overall performance and optimize their capital utilization. 5. Capital buffer and risk appetite. Maintaining a capital buffer is fundamental to sound capital planning. It provides a cushion to absorb unexpected losses and ensures that the bank remains well capitalized during periods of stress. The buffer should be determined based on the bank's risk appetite, regulatory requirements, and the potential impact of unforeseen events. Striking the right balance between risk-taking and capital adequacy is crucial. 6. Risk management and internal controls. An integral part of capital planning is robust risk management and internal controls. Banks must have adequate systems in place to identify, measure, monitor, and mitigate risks effectively. This includes evaluating credit risk, market risk, operational risk, and liquidity risk. By maintaining strong risk management practices, banks can enhance their capital planning capabilities. 7. Regulatory compliance. Compliance with regulatory requirements is paramount in capital planning. Banks must stay updated with the latest regulatory guidelines and ensure that their capital planning processes adhere to these standards. Compliance with regulations not only helps banks avoid penalties and reputational damage, but also fosters trust among stakeholders. Capital planning is an ongoing process, and banks must regularly review and refine their strategies to adapt to changing market dynamics and regulatory requirements. By implementing these strategies, bank treasuries can strengthen their capital positions, improve risk management practices, and enhance long-term sustainability.
Join the Global Banking Hub today and unlock an extensive library of Treasury video courses with new content added every month to keep you up to date on the latest industry standards and practices. Whether you're looking to deepen your understanding of interest rate risk management, liquidity coverage ratios, or Basel III compliance, our expert courses are designed to give you the skills and knowledge you need to excel. Each course comes with a practical certification opportunity, allowing you to demonstrate your expertise and advance your career with feedback from a senior Treasury professional. As a member, you'll also receive our weekly Global Banking Update reports, packed with actionable insights on global banking trends, regulatory changes, and market movements, giving you the tools to apply the latest developments to your organization's strategic decisions. Finally, our in-depth how-to guides provide step-by-step solutions to complex Treasury challenges, from calculating liquidity ratios to managing non-maturity deposits. These practical guides ensure you're equipped to tackle the real-world issues that matter most to your role. Become a member today.